right, good afternoon, everybody. We will get started shortly. We'll let a few people trickle in here before we get started. So sit back and relax for a few minutes, and we will get started in just a few minutes. All right, good afternoon and welcome to today's webinar, What About Taxes? Common Tax Planning Strategies. I'm going to go ahead and get started. We may have a few folks that will be trickling in over the course of the meeting, but that's okay. I've said this before that if you register, you will have access to the replay of the video on our website and as a registered participant. So no need to sit through the live version, but if you want to ask questions, then obviously participating live definitely allows for us to talk about taxes in more depth or whatever subject that we're talking about. But today's about taxes, given the time frame that we're in right now at the end of March 2026. The April 15th tax deadline is looming upon us, and so there are some things that we'll talk about today that might provide a spark of idea about a situation that you might take advantage of that might help improve your taxes, not just for this tax filing season, but maybe at some point in the future. Okay. So today we've got quite a few tax strategies to discuss. I'm not going to go through all of them in depth, but I will highlight a number of them. And if we need to come back around and do a follow-up session on some of these strategies to provide more in-depth details about how to execute them, we can certainly do that. But this is going to be kind of a high-level glance over taxes and some of these tax strategies. Clearly, they can be more detailed and nuanced based upon an individual's specific tax situation. So just view this as kind of a guideline for some of these ideas that you might want to consider. Okay, before we jump into it, I've got to provide an important disclosure. This presentation is intended for educational and informational purposes only. It is not intended to provide and should not be relied upon for tax, legal, or accounting advice. Although we do go to great lengths to make sure our information is accurate and useful, each individual's financial and tax situation is unique. Please consult a qualified tax professional before making any decisions based upon the OBBBA or any other tax law changes. Information presented is based upon sources believed to be reliable as of March 2026, but may change with future IRS guidance or legislation. So take that with take this with a grain of salt and use it as educational, but certainly consult a tax professional regarding your personal tax situation. All right, so moving on. Why this matters. As I presented during the OBBBA webinar last year, we have had this, fairly significant tax law change that took effect. Most of it's taking effect in 2026. There was a few things that applied to 2025, but most of it is applying to 2026. Many of the provisions that were passed into law are permanent, and they may have an impact changing long-term planning. There are some new deductions that reward income timing and reporting accuracy. If you make moves before year end, if you make good, smart strategic moves, they can have the impact of lowering your taxes over your lifetime, not just in the year that you make them. So today's goal is to help you understand what has changed in the tax code, what it means for you, and how to proactively use some of these common tax planning strategies. Okay. All right, and obviously feel free if there is something that you need me to repeat or you have a question on, feel free to interrupt me, or we can take a pause and clarify something. I'll just keep going unless there is any particular questions. So, all right, so the tax landscape has obviously shifted. We had the One Big Beautiful Bill Act, the OBBBA, that was signed into law last July. It made many of the provisions from the previous Tax Cuts and Jobs Act, or the TCJA, made many of those permanent. It also introduced a number of above-the-line deductions, and we'll go and talk about what that means about above-the-line deductions. Some people are familiar and some people are not so much. So we'll just cover that briefly. Expanded standard deductions and adjusted brackets. We'll review the standard deductions and the tax brackets briefly. And most of those apply to the 2026 returns, so this year's tax returns to be filed in 2027. But again, also apply to 2025 as well. So takeaway, this isn't a one-year tax tweak. It reshapes the long-term planning decisions. So a lot of this stuff was put in permanently rather than having phase-outs. So that provides some additional stability for decision-making. All right. Okay, so before we jump into some of these things, let's just do a quick overview of how currently a federal tax return works. And if we're talking about state tax returns, that's a little bit different. Each state has its own forms and such, so I won't get into state level tax returns. We're just going to talk about the federal tax return, the 1040. So at the top line here, we have total income. So total income is going to be composed of all sources of income: wages, interest, tips, overtime, but also pensions, retirement account distributions, those types of things. So anything that is deemed income falls under your total income line. It also includes capital gains income. Some people forget that as well. Okay. So under your total income, you have what are called above-the-line deductions. So what above-the-line deductions do is they reduce your adjusted gross income. Okay. So you might team the adjusted gross income, or AGI, as sort of the magic number or the line on your tax return. Okay. And so some of these above-the-line deductions are retirement contributions to IRAs, health savings account contributions, student loan interest deductions, and also some of these new deductions that were just added with the new law of tip deduction, overtime deduction, car loan interest, and the senior deduction. So we'll review some of those items. So after the above the line deductions, that gets you to adjusted gross income. Okay, so that's the important number. That is the number that most of your tax calculation is based upon. Okay, so you have your adjusted gross income, and then below that you have what are called below the line deductions. So your AGI is considered the line. So below the line deductions are primarily composed of either your standard or itemized deduction. Okay, and so we've got the standard deduction here versus the itemized deduction. If you have a mortgage, you have state and local taxes. That's the SALT deduction. You make charitable donations, a number of other things. Those are all classified as itemized deductions, and you choose the one or the either or that's larger, and that is what is used to determine your taxable income. So once you get to your taxable income, then it's simply a matter of applying the appropriate tax rate and any credits that you might get, such as the child tax credit, education credits, or otherwise. So the difference between a deduction and a credit is a deduction reduces your adjusted gross income, or if it's an above the line, it reduces your gross income. So deduction reduces your income. A credit reduces the tax. So once your tax is calculated, a credit reduces the amount of tax that you're owed. So generally speaking, credits are better than deductions because credits typically reduce your tax on a dollar for dollar basis, whereas a deduction reduces your income, but then that income is, you apply your tax rate against that income. Okay, so just one takeaway there: credits generally are better than deductions. I mean, you'll take either one of them if you have them, but certainly reducing the tax liability is more important than the income. Okay, so that's a simplified view of the 1040. So let's talk about the expanded standard deduction. And this started under the Tax Cuts and Jobs Act, but has now been increased. So the new standard deduction for 2026 for a married filing joint couple is $32,200, or for somebody that is single or married filing separately, it is $16,100. And if instead you file as head of household, you get a little bit of a benefit of a standard deduction of $24,150. So why is this important? It's because we have a much more significant amount of taxpayers that are benefiting from the standard deduction versus the itemized. And if anybody has done their schedule, Schedule A, their itemized deduction form, will realize that it's a lot of work to collect all of that information to craft your itemized deduction. So these increased amounts may change the strategy for whether you use a standard or itemized deduction. Generally speaking, some of the bigger items on the itemized list are going to be mortgage interests, state, local, and property taxes are going to be itemized items. Charitable donations are going to be items that are going to fall under the itemized deduction. So if those costs for you exceed the standard deduction for a year, then you would take the itemized deduction. Otherwise, you just take the standard and make it really simple. Okay. So the last item there makes other deductions additive rather than competing. So oftentimes with charitable donations, if somebody is charitably inclined, but their donations do not exceed their standard deduction, then you don't really get a tax benefit. And there's actually been a helpful change to the tax tax form that helps to offset some of that with the new OBBBA. Okay. So additionally, we got permanent lower tax brackets and deductions. So the current individual tax brackets are now 10% to 37% instead of the 39.5. You've got, like I said, it's higher standard deduction. We did have the elimination of the personal exemption. I don't know if anybody recalls, since it's been so long, we used to have an individual personal exemption for yourself and anybody else that's on your tax return. I think it was 2,000 and got up to like 4,000 or something of that nature. So that's been eliminated in favor of the higher standard deductions. Okay, so the fact that these things have been basically made permanent means that we have better certainty for doing retirement income planning, or just working age income planning. You can do a better job of planning for what your tax situation is going to look like. You can make better decisions about whether or not to make Roth versus traditional IRA or retirement plan contributions, and it gives you the ability to do some multi-year tax projections, so we don't have this persistent risk of the sunset risk that what we're planning on today is going to be obsolete tomorrow. So we don't have that anymore, at least as far as the time being. Now, I will provide a caveat that yes, tax law can change with any change in administration or change in congressional makeup, but for the time being, I think that what we have in place here is probably going to be fairly permanent, given how difficult it has become to make some of those tax law changes in the current political environment. So I think we've got some ability to do some planning now based upon some degree of certainty. Okay, so I think that's a good thing. All right, so let's just talk about some of these new or enhanced deductions under the OBBBA. So the first one is the senior deduction. So they wrote into law a $6,000 per person that is age 65 and over. So if you're a married couple, you get an additional $12,000 deduction in addition to either your standard deduction or your itemized deduction. So that's going to be very helpful. This was put into place effectively to try to make Social Security not taxable. So the argument, kind of when they were campaigning about making Social Security non-taxable, unfortunately, I have to quash that idea. Social Security still is potentially subject to tax. If your income exceeds those levels, it makes it taxable. However, this senior deduction for those that are 65 and over helps to offset some or all of that tax that will be associated with Social Security being taxable. So just it does one thing that kind of offsets it, but Social Security is still subject to the tax calculations if your income reaches that level that makes it taxable. I also want to mention that the senior deduction is actually phased out for somebody that makes $75,000 single or $150,000 as joint. So if your income, which would be Social Security, pension, or other IRA deductions, required minimum distributions, those things exceed those thresholds, then you start to lose entirely this senior deduction. So keep that in mind. All right, number 2 is the tip income deduction. So this provides up to $25,000 of qualifying tips as a deduction against your income. So that applies to both W-2 or 1099 tips. It also has a phase out that begins at $150,000 single or $300,000 joint. So a little bit higher than the senior deduction, but still a phase out. I do want to mention this tip deduction only applies to the. Oh, I'm sorry. I'm thinking about the overtime. So it is what is called for qualified tips for jobs that are subject to traditional receipt of tips. So think waitresses, waiters, waitresses, other types of positions, Uber drivers, etc. That would be subject to receiving tips as part of their regular compensation. All right. Number 3 is overtime pay. So if you are eligible for overtime, you're eligible for up to $12,500 per individual. So that would be, $25,000 for a married couple. So $12,500 per individual. It applies only to the FLSA qualified overtime. What does that mean? So it is the overtime. So I'll give you an example. If my normal wage is $20 per hour and my overtime wage would be $30 an hour, so one and a half times my normal pay, time and a half. The overtime deduction is only eligible for the $10 above and beyond my normal pay. It's not on the full $30. Okay, so employers are now having to struggle to distinguish between what is qualified overtime pay deduction item versus not. So if that applies to you, then I would say talk to your HR representative or who else might be able to help you identify the portion of your wages that are eligible for this overtime pay deduction. And then the last one on this list is the car loan interest deduction. So if you buy a new American-made vehicle, okay, then you are eligible to deduct up to $10,000 of interest per year on the purchase of that vehicle. Okay, so this is new personal use vehicles only, and the loan must originate after December 31st, 2024. Okay, so you'd have to have bought it in 2025 or going forward, but if you need a new vehicle, then you do have, and you plan on financing it, then you do have this additional interest deduction to rely upon. All right, so as already kind of alluded to this, so above the line deductions, they reduce your AGI, they improve eligibility for things such as Roth contributions or Medicare IRMA thresholds. Let me just touch on that. IRMA, so if you are enrolled in Medicare, then you are subject to this income-related monthly adjustment that is called IRMA. So it's basically the means tests for your Part B and Part D premiums. So your Part B and Part D premiums can be adjusted up on a monthly basis. You can pay more based upon income. Sometimes we see situations where somebody might have received or sold a house or received a payment or a bonus or something else that causes their income to spike in a given year. That's when you get this surprising IRMA adjustment. So if you have any one-time events in your income, I would suggest that you contact Medicare to see if you can get a waiver on that. Otherwise, you sometimes get Medicare IRMA surprises. So So AGI helps to reduce your, some of these things help to reduce your AGI and then allows you to stack these deductions on top of the standard deduction. So, all right, let's look at the tax brackets briefly, just so everybody has an understanding of how our tax bracket system works. Our tax brackets are considered progressive. They're considered a progressive tax calculation. And so the way that it works, so we'll just look at the single filers on the left-hand side of this slide and the married filing jointly on the right-hand side. Okay, so on the left-hand side, it shows taxable income from 0 to 12,400. And for incomes in that range, the income would be subject to 10% of the taxable. So if your taxable income is between 0 and 12,400, that income is applied a 10% tax. Okay. So then if your income exceeds 12,400 and moves between 12,401 and 5,400, well, then you're adding that amount of income is applied a 12% tax. And on down the list, so every time your income falls into that threshold, you're getting a higher rate. All of the income previously is still taxed at those lower rates. Okay, so the reason it says in that second bracket 1240, 1,240, so that is the tax from the 10% bracket. So the 10% bracket plus 12% of the amount that falls into that next bracket. So as you move into higher tax brackets, not all of your income is being taxed at the higher rate. The income previously is still taxed at the lower rates, but any additional income is taxed at a higher rate. So oftentimes when I'm just having conversations with somebody about whether or not they should take a distribution or how they should structure their bonus or those types of things, the question is, all right, what tax bracket is that income going to be taxed at? So for somebody that might be in the, already in the 32% tax bracket, if that additional income is going to push them into the higher 35%, well, then I will have a conversation. All right, are you willing to pay that higher tax amount versus maybe deferring it or doing some other type of tax planning strategy? Okay, so the tax structure is structured that way, both for single filers, married filers, head of household, etc. The one difference, though, is that we've seen is the range. If I highlight the range here of the income, that can change, and that has changed. In fact, in this new tax law, these ranges of what amount of income is applied at the lower 10 and 12% brackets, that is what has changed and widened. So more of your income is being applied at the 10 and 12% bracket now versus where it was before the tax law changed. So that's actually positive and helpful for pretty much everybody that files a tax return. All right, a couple of updates for retirement planning. So we've got IRA and Roth contribution limits. So for those under age 50, they can now make a $7,500 IRA or Roth IRA contribution, and those that are age 50 and over can make an $8,600 contribution. So being able to contribute to these provides for higher tax deferred or tax-free growth. You do get the benefit of the above the line retirement plan contribution deduction. Okay, and even if you are in a higher income situation where you're not eligible to make a direct Roth contribution, you can consider making a backdoor Roth contribution. And I'm going to go over that in the next webinar coming up next month. So So planning strategy here is making sure that you're coordinating those deductions, income timing, Roth funding. You're not doing it in isolation. You're doing it in coordination with those other things that you're doing. Okay. The folks that are going to see the most benefit from these things are those that are near or in retirement already. Those that earn tips or overtime if you plan to purchase a vehicle. You're managing your Roth eligibility, and you want predictable long-term tax rules. So that's what we. It's not perfect, but it's better than what it was. All right. Not every deduction applies to every taxpayer every year, so strategy matters more than headlines. Okay. So here's some practical tax planning strategies. So you want to have a good idea about what your income might look like for the year. You're going to evaluate vehicle purchases versus financing time if you're looking at buying a vehicle. I always suggest people to maximize retirement plan contributions as much as they can. Obviously, keeping in mind things that you have to, the trade-off between money that you need to pay bills and keep the lights on versus saving. But obviously, the more you can contribute, the better. We're going to talk about harvesting capital losses in a bit, as well as bunching strategies. Withholding versus estimated payments. So oftentimes people have a choice about whether or not they should have taxes withheld out of their payments, either from their wages, from their pension, or other payments, versus making estimated payments. So we can talk about that. Some of the deductions have eligibility requirements, so you need to confirm whether or not you're eligible for those deductions that you're claiming. So this bottom line item is tax planning is proactive, return filing is reactive. So if you're just taking your tax documents when you get them and you're not doing tax planning to make sure that you're hitting the right amount of taxable income to minimize your tax over your lifetime. So that's what tax planning is. It's trying to minimize your total tax liability over your lifetime rather than just kind of taking it and dealing with whatever the results are. Just to hit on Roth conversions. So sometimes this confuses people, so I want to make sure I'm clear about it. Like I said, next month I'm doing an entire session on Roth conversions. So a Roth conversion, what is it? Basically, you are moving money from a pre-tax retirement account, such as a traditional IRA or old 401k, and you're moving that into a Roth IRA. Okay? Or if you're still employed, you're moving it from a traditional pre-tax 401k into the Roth 401k side. What does this do? This causes you to pay tax now. So it increases your tax liability in the year that you're doing the conversion, but it provides for that growth on that amount that you convert to be tax-free, basically on into the future, infinite, however long. So tax-free income later, so you don't have any required minimum distributions, and it gives you the ability to hopefully control or have better control over your tax rate, rather than being pushed into higher tax brackets based upon required minimum distribution. So effectively, you're kind of taking your fate into your own hands versus the government forcing you to take distributions down the road. So if you're interested in learning more about Roth conversion strategies and how to think about Roth conversions, I will be doing a session next month on that topic. All right, tax loss harvesting. This subject is a little bit sensitive for people. Effectively, what is tax loss harvesting? You're taking market losses, so stock market losses that you might have in your portfolio, and you're trying to utilize that to turn it into tax savings. So you are selling an investment at a loss to help reduce taxes, and then you're reinvesting that money to stay aligned with your long-term strategy. So why would we do this? I mean, most of the time when we're making investments so that those investments will grow in value and not lose value, right? Well, yes, that's absolutely correct. But when we have an investment strategy, there's no guarantee that something is going to go up. I mean, if we look at the current situation with the conflict in the Middle East, nobody was really predicting that we were going to be in a conflict that was going to spike the price of oil. So, if somebody was if an oil trader was on the hook to sell oil at $60 a barrel, and now they have to buy it at $100 a barrel, well, now they're losing money. So that would be a situation of potentially a capital loss. And so when we're talking about tax loss harvesting, if you think about your portfolio, if you have holdings that have lost positions in them, well, you have two decisions. You can either hold that investment with the prospect that it's going to eventually go up sometime in the future, or you can sell it and reinvest it. Now, the tax laws around capital gains, you have two different types of capital gains. You have short-term and long-term. Okay. Whenever you sell an asset and realize either a capital gain or a capital loss, you have to be out of that position for a minimum of 30 days. So you can't sell it today and then turn around and buy it back tomorrow. You have to wait a period of at least 30 days. Otherwise, it becomes what's called a wash sale. And so what a tax loss harvesting strategy does is says, all right, maybe if I've got a loss reflected in my portfolio of I'm just going to say the S&P 500, okay, maybe an iShares ETF. Well, I can sell that and I can realize the loss, and that loss is going to help me from a tax standpoint. And I can buy a similar asset, not the same asset, but maybe it's something similar. All right, maybe it's a different ETF that's also invested in the S&P 500. They're not the exact same security, but it's similar, and it keeps my investment strategy aligned for my future. So that gives me the ability to sell and realize the capital loss, and I can use that loss to offset any other gains that I might have already realized. Okay. So maybe I've sold some other assets and I've realized some capital gains. Well, by selling this lost asset, but in reinvesting it into something similar, I'm able to capture the loss, offset the capital gains that I've incurred, but keep my portfolio invested for the longer term growth. So that's what it means by offsetting capital gains. Losses can offset gains from investment sales, real estate, business transactions. Now, if I don't have any capital gains or I don't have enough, those losses can be used to offset up to $3,000 of other income that I may be incurring. So that could be wages, that could be rental income, that could be other things. But once I've exceeded 3,000, then any of the losses that I've incurred get carried forward into future years. So by doing this potentially helps to improve after-tax returns, right? So taxes saved today can be used to be invested and compound over time, and it provides this planning flexibility. So losses can be banked for future high income years. So maybe if I have a dog in my portfolio that's never going to return, I can realize the loss on that and use that loss to offset some future sales that I might be expecting to get in the future. Okay, so that is tax loss harvesting. The next item here is the next idea is called charitable bunching. And charitable bunching applies to primarily those people that are doing itemized deduction. If you're using the standard deduction, this doesn't really apply. Now it can a little bit, but primarily it's applying to those that are itemizing. And so, if you're charitably inclined and you're doing a sizable amount of donations, but you are not able to itemize because your charitable donations do not exceed the standard, well, instead what you would do is, rather than giving your donations over a 2-year period, like maybe I'm giving $15,000 this year and $15,000 next year. Well, instead of doing that, what I would do is I would give all of it. I'd do $30,000, maybe all in January of next year, right? That way I'm getting the entire tax benefit of that charitable donation in 1 year that I'm able to use in order to qualify for itemizing. So that way I'm getting some benefit, some tax benefit from those donations. So now I will say this year, you now have the ability to do a up to $1,000 below the line deduction, charitable donation. Okay, so they've now carved out where you can donate up to $1,000 without having to itemize. That's a really good thing, especially for those that do smaller regular donations but don't get any tax benefit from it. So that's helpful. So just keep in mind. So we've got the standard deduction here of $32,000 for married filing jointly and $16,100 for a single. So using those numbers and looking at your charitable donation strategy, if your donations could exceed that standard deduction, then bunching might be an appropriate strategy for you to consider. All right. And then this last idea here, there's a few more ideas I'm going to go through, but I've got some detail on this one. So qualified charitable distributions, or QCDs. So this generally applies to those that are eligible to take required minimum distributions. Actually, it used to be completely tied to those that are taking required minimum distributions, and now because people that were 70 and a half were already started, they left the age at which you can do qualified charitable donations at age 70 and a half. So even if you don't have a RMD yet, required minimum distribution, you still can do a QCD. But again, this strategy has been primarily used for those that are subject to required minimum distributions, which is now the age at which you are required to start is now 73, and that will be going up to age 75, I think in the next 5 years or so. So if you are 73 and you have a required minimum distribution, that RMD is the IRS forcing you to take money out of your retirement account, and they're forcing you to pay taxes on that. What the QCD allows you to do is, rather than you taking that money directly to your bank account, it allows you to take that money from your retirement account, say from your IRA, and send it directly to the charity of your choice, whether that's your church, your alma mater, some foundation that you feel passionate about. If it's a qualified 503c charity, you can have your required distribution sent directly to that charity. That does two things. It satisfies your RMD, okay, and it does not count as income to you in which you're going to pay taxes. So it's kind of a double win. The charity gets the money, satisfies your RMD, and you don't have to pay taxes on it. So, however, just keep in mind, if that's the case, you don't get to double dip. You don't also get the charitable donation deduction for that amount that you've given. It's either one or the other. You can either take the QCD or you can write a check as a donation. But generally speaking, if you're subject to required minimum distributions, the QCD is the better strategy. Okay, and why is that? Because it lowers your taxable income, lowers the overall tax brackets that you might be in. Hopefully, it offsets or reduces the Medicare IRMA adjustment that you might be eligible for, and it might even lower the amount of your Social Security that is subject to taxation. So, lots of good benefits to your QC using the QCD strategy. I will also say that it does not have to be an all or nothing thing. You can do a partial QCD rather than the entire amount. So let's say if your required minimum distribution is $50,000 for the year, and you need $25,000 maybe to pay the taxes, you can still have the other $25,000 go as a QCD, and then you're only paying taxes on the 25 that you receive rather than the full 50. All right, so here are some other smart tax planning strategies that I'm not going to do a deep dive into, but it's worth mentioning. And if you think it's important enough that I come back and rehash these or do some additional deep dives into these strategies, I'm happy to do that. But let me just go through these, and I think you'll see why maybe I left them off the deeper list. So income timing, so deferral and acceleration. So taxes are based upon when the income is received, not just how much. So if you have the ability to either accelerate income into the current year or defer it into the following year, that gives you some control over how much tax you're going to end up paying, what tax bracket you're going to end up being in each of those respective years. And so by the ability to control your income timing might allow you to save on taxes in its entirety over that period of time. Capital gains planning, so just like tax loss harvesting, capital gain planning is trying to determine when the best time to realize a capital gain income might be. Generally speaking, you're going to want to do capital gains. You're going to want to incur capital gains in lower income years because you will be subject to a lower capital gains tax. The capital gains brackets are 0, 15, and 20%. And I want to say, I think the 0% capital gains bracket is at 75,000. So if your income is below 75,000 for the year, you can incur capital gains and not pay capital gains tax. So that is that's a good thing, right? And anytime you're able to take income without paying tax, that's a good thing. So so capital gains planning is another strategy. Asset location. So what this means is you want to place investments in the most tax efficient account type. Investments that have a lot of income, right? They're paying lots of dividends, have high yields. Those would be generally investments that I would classify as tax inefficient. And we would generally be leaning towards putting those into retirement accounts in which you're not paying taxes on an annual basis. Versus if I have those in a regular, individual brokerage account, I'm going to be getting 1099 dividend income, and I'm going to be paying income taxes on that. So that's an example of determining asset location of where the best place to put specific types of investments in different types of accounts. Health savings accounts are obviously a great idea for those that are planning for healthcare expenses. So you got a triple tax advantage of deductible contributions, tax-free growth, and if it's used for medical purposes, tax-free qualified withdrawals. So tax-free is always a great thing. So if you have health savings accounts available to you, then I strongly encourage using those. Medicare premium planning, already kind of hit on that, but if you're subject to IRMA, being able to plan for when that's going to trigger and knowing what you might be on the hook for as far as additional Part B or Part D premium costs is important. Social Security tax management, knowing how much of your Social Security benefit is going to be taxable based upon your other income helps you to make smart tax choices. And then gifting strategies. So the OBBBA put into place the permanent gift and estate tax exemptions. And so now that those are permanent and fixed, you have the ability to do better gifting and estate planning in order to minimize potential estate taxes down the road. So doing things such as using your annual gift tax exclusion, paying tuition or medical expenses directly, or shifting assets to lower tax family members are all strategies for how you might manage the taxes both now as well as into the future. Okay, so these are all other smart tax planning strategies that you might consider as you look at your tax situation. Okay, so just a couple of takeaways. We're at 12:50 here, just to kind of wrap things up. So 2026 introduced some significant tax changes. We talked about the larger standard deduction, permanent rules allowing smarter tax decisions. Doing some personalized planning helps you to unlock the real value in these ideas. So I would suggest reviewing your 2026 tax picture. I always recommend, in addition to doing your taxes, as we get towards the end of the year, maybe into November or December, you're looking at the full year's tax picture so that you can make decisions before the end of the year and lock in any of those smart tax decisions that you might be thinking about. So identify which of those tax revisions apply to you. Talk to your accountant or tax professional. Talk to us as far as how to implement some of these things. So you're going to want to coordinate your tax, retirement, and cash flow planning to make sure that we're maximizing and making the most ideal circumstance for you. And so I'll leave you with this quote at the bottom. So good tax planning isn't about paying less this year. It's about paying less over your lifetime. So you're only obligated to pay the amount of taxes that you are obligated to owe by law, no more, right? No less. So, but knowing how these rules might apply to you is the first step in paying less over your lifetime. So hopefully this has been helpful for you. I am going to now open it up to any questions that you might have. Feel free to unmute yourself, throw it at me if you've got anything that's particularly on your mind. Okay, any questions that we may have? Doesn't look like there's any questions. But of course, if you do have any particular questions about some of the subjects that we covered today, I'm happy to have a separate session with you. Just give us a call and get on the calendar, and happy to talk through some of these things. All right, what's coming up? So our next monthly market update is on Wednesday, April 8th at 11 a.m. Pacific. This is when I review the monthly market update information that's come out from the previous month, discuss what's happening that's affecting the markets, and talk about how we might be interpreting what might be the future. So predicting the future is always an interesting thing. But understanding what's happening is important. So if you want to join me for the monthly market update, that should be coming up on Wednesday, April 8th. Also, as I had mentioned, the next educational webinar is on Roth conversions. So to convert or not to convert to Roth is the question, all about Roth conversions. That will be happening on Wednesday, April 29th at 12 p.m. So I hope you can join me for that session as well. The Roth question is always one that gets a lot of questions and debates. So hopefully that will be valuable for you as well. So with that, that is all I have for today. I do appreciate you joining me, and again, hopefully this was helpful, but I look forward to seeing you at the next one. Thank you, everybody. Have a great rest of your day.